Hi, my name is Louis Navellier, and last week my 25-year-old daughter, Crystal, sent me a screenshot of her brokerage statement. It was her 2025 return, and it read up 31.75%. For context, that's nearly twice what the S&P 500 delivered in the year. It's better than what small caps, value stocks, and the vast majority of other popular investments did last year. And it's roughly 10 times what the average investor returns annually on the S&P 500. But here's the part that should terrify every professional money manager in America. My daughter didn't study finance or economics in school. She didn't become a junior analyst or investment associate upon graduating. Instead, she got an arts degree and moved to New York after college to try her luck in the film industry. She lives in an apartment the size of a shoebox that costs 60% of her paycheck and spends the leftover money on oat milk matcha lattes that cost $8 a pop. And yet, in 2025, she beat Warren Buffett, who returned 11%, Bill Ackman, who returned 20.9%, and Ray Dalio, whose all-weather fund returned 20%, as well as roughly 90% of the money managers overseeing active funds in America, including, most likely, whoever's managing your retirement account right now. How is this possible? How did a Gen Z kid who prefers arts to balance sheets crush legendary investors with decades of experience and billions of dollars under management? The answer isn't uncanny talent or even dumb luck. Put simply, Crystal uses an investment system I created back in the 1970s. And in the 30-plus years I've been sharing this system with my readers, I've outperformed the S&P 500 by a margin of nearly 2 to 1. That's through bear years and bull years and everything in between. This strategy relies on a proprietary algorithm that helps identify the most promising opportunities in the market today. And yet, it's so straightforward, I taught it to Crystal over pizza dinner one night. If you can sing the ABCs or read a grade school report card, you can use this system too. But here's where this gets critical, and I need you to pay close attention. What I'm about to share with you in the next 10 minutes could determine whether you retire comfortably or whether you're forced to work into your 70s. Because chances are, if you invest the same way most people in America do, which I mean putting your money in an index fund and allowing it to accrue over time, your money is at risk. In recent months, the situation has become so dire that I warned Crystal never put her money in an index fund. I want to show you why this investment method, long considered one of the safest and smartest options for individual investors, has become a ticking time bomb. I also want to show you how you can use my proprietary ABC investing method instead for the chance to generate massive gains. This system has been at work for my family, myself, and thousands of my clients for close to 4 decades. It works in bull markets, bear markets, and everything in between. And it's especially powerful during the types of market conditions we're witnessing today. So don't go anywhere. In the next few minutes, I'm going to expose to you the big Wall Street lie that's putting investors' money at risk, including potentially your own. I'm going to show you how investing in a small number of carefully chosen stocks could put you on track to outpace the markets. And I'm going to share the details on 7 stocks I think you should be buying immediately. My latest research shows these stocks are not only poised for huge growth in 2026, they could explode at any moment. In fact, one is so urgent, I'm going to give you the ticker symbol and buy price during the course of this presentation. Companies that were similarly rated by my system have historically gone on to deliver gains like 276%, 390%, 790%, and sometimes much, much more. I would hate to see you miss the chance to take advantage of this new opportunity today. So let's get started. Before anything else, I like to show you exactly what I mean when I say my strategy has allowed Crystal to beat the market by almost 2 to 1. In 2025, the S&P 500 delivered a strong return of 16.75%. It was a great year, particularly in light of the geopolitical uncertainty, shifts in U.S. trade policy, and erratic consumer demand that we saw that year. The fact that the S&P 500 hit all-time highs was impressive, especially when you consider analysts had warned of more than usual uncertainty going into the year. And if you had your money in the S&P 500 last year, I'm sure you were happy with the results. I wouldn't blame you. But Crystal, her money grew at 31.75%, meaning she didn't beat the market, she nearly doubled it. And that wasn't an anomaly. The year before was the same story. In 2024, the S&P returned 23% over the course of the year. The NASDAQ did even better at 28%. That's a remarkably good performance by anyone's standards. Economic growth combined with cooling inflation for what Axios called a fantastic year. CNBC wrote, years like this one are rare. And again, anyone who had their money in the indices wouldn't be blamed for raising an extra glass of New Year's champagne to celebrate their handsome returns. But Crystal, she beat them all with a performance of 33.88% on the year. That's a full 10 percentage points higher than the S&P 500, an edge most investors never see in their lifetimes. All because she was using the straightforward investment strategy I taught her. Now let's imagine you had put $100,000 in the S&P 500 back in January of 2024. Over the next 2 years, your money would have turned into a little over $143,000. But Crystal, using my method, would have turned that same money into more than $176,000 by the end of 2025, all by using the approach I taught her. I don't know about you, but an extra $33,000 is nothing to scoff at. And yet, as I'm going to show you a bit later, most investors will never see these kinds of gains, as long as they continue to trust the Wall Street narrative that indices are the best and safest way to invest in the stock market. This infuriates me, especially in light of the fact that my system has historically returned nearly twice as much as the S&P 500 ever since I first began sharing my research in the late 1990s. We'll get back to that whole story a bit later. But for now, let me show you how my system actually works, beginning with how I came up with it. Funny enough, I came up with this strategy by accident. It was the late 1970s, and I was studying finance at Cal State Hayward. This was well before Crystal was born, when I was just a young college student myself, with nothing but a few dollars to my name and typical ambitions of greatness. Just look at this guy. Little does he know that, in the next several years, he's about to make his first million thanks to a strategy he'll come up with largely by accident. You see, in one of my finance classes, my professor gave me an assignment that would change my life. He asked me to create a financial model that would mimic the S&P 500. He wanted me to prove that indexing was the best way to invest. So I got to work using the powerful Wells Fargo mainframe computers that were cutting edge back in the day. You remember these? These machines took up an entire room. But they were able to process data in a way that hadn't been possible before. And with the help of many cups of coffee and late nights, I built an algorithm and completed the assignment. But when I handed in my final results to my professor, I was flushed with embarrassment. I held my breath as he scanned my work. You see, my algorithm hadn't just mirrored the S&P 500's performance, it had actually beat it. Contrary to what my professor had wanted to teach me, the stock selection model I devised had shown that investing in a small number of carefully selected stocks could deliver far superior returns to a passive investment like an S&P 500 index fund. Most importantly, my algorithm revealed that the stocks that kept beating the S&P all shared certain key characteristics. I was fascinated by this discovery and pursued the system, refining it and applying it to my own investments. I knew I was on to something good when it helped me make my first $1 million before the age of 30. I decided to create my first stock picking newsletter, which I found from my dorm room. And the results spoke for themselves. From 1985 to 1992, my portfolio returned 954%. making it the best stock picking service in the nation. According to the Wall Street Journal, most money managers could only dream of having the kind of success I've had. Of course, some said I just got lucky. Others insisted it wasn't possible to beat the markets. Not really. But by then, my model portfolio had returned an average of 24.9% over a 10-year period, beating out the broader markets 13.6% by almost 2 to 1. And I trusted that my system could continue to find stocks that would perform well. In the years that followed, my clients and I reaped the rewards of that trust. In 1997, for example, I recommended buying pharmaceutical company Schering-Plough. By the time we closed out that position in June of 1999, the S&P 500 had returned an impressive 49%. But my readers had the index handily beat, as Schering-Plough's stock had doubled in value over the same period. That same year, I also recommended Dell. It brought my readers a gain of 307%, which was enough to multiply their money threefold and beat the market nearly 6 times over. The year after that, I recommended buying Nokia. And when the stock went on to register a gain of 252%, nobody was wishing they kept their money in the S&P 500 instead. The 34% that the S&P returned over the same period paled in comparison to what my system had allowed readers to do with their own money. With one stock alone, we were able to do more than 7 times better than the market. This wasn't just luck. This system was legit, and the results were impossible to contest. By the new millennium, the New York Times was calling me an icon and one of the country's best-known investors. My newsletter was ranked number 1 for the 20-year return category in the Hobart Financial Digest, and Forbes was calling me the king of quants. In fact, from 2000 to 2009, the average gain of my closed trades beat the S&P 500 in 8 out of 10 years. All in all, since I first started using my proprietary system, I've beaten the S&P 500 nearly 2 to 1. That's 33 years of outpacing what were promised to be the best, the safest, the most reliable way to make money. Not by a small margin, not from time to time, consistently and by a lot. For most money managers, beating the market by a small margin is already a big success. And as we'll discuss a bit later, most of them fall short of the average. While my system has consistently allowed me to run laps around the market, and the best of those picks have outdone the indices tenfold. Consider that in the nearly 40 years I've been using my system, I've identified more than 675 opportunities that could have doubled your money in the long run. And in the 20-year period between 2003 and 2024, a backtest shows the stocks favorably ranked by my system would have returned 4.5 times the NASDAQ indices, 6.5 times the S&P indices, and 8 times the Russell 2000. But as you're going to discover in just a few moments, these kind of results are just the tip of the iceberg when it comes to making big money on well-picked stocks. Because my team ran the numbers in another backtest and found that the upper tier of stocks identified by my system would have turned every $100 invested in 1998 into $13,629 today. Compare that to the S&P 500. Over the same period, $100 would be worth only $1,059 today. As for the top stocks of all, the smallest collection of those ultra-strong players, even better. They come in at a whopping $385,180. So you can see why I was forced to come to the conclusion that when you compare the indices to my own system, the S&P 500 looks like one of the worst performers in the race. Of course, this is back-tested data, and it's no guarantee for real-world results. All investing carries risks. Trust me, I don't say this lightly. After all, I grew up in Berkeley in the 1970s. I was raised under the promise of peace, love, and index funds. And I, too, had heard the conventional wisdom that investors should avoid stocks at all costs. It's too risky, people said, too volatile. You never know what one stock might do. Instead, we were encouraged to put our money in the indices. Safe, reliable, steady. The best way to ensure your money grows, so they said. And when the first index fund was created, that was generally the idea. Jack Bogle created the first index investment trust with Vanguard because he wanted something that would help retail investors compete with the pros. He wanted to give people a way to passively invest in a large bucket of stocks. It was a nice idea. Low fees and minimal trading. People would have the upside of holding a diverse array of stocks, all while avoiding the downside of human error. Of the people, for the people, and all that. Family men poured their savings into index funds, telling themselves they'd let their wealth accrue gradually over time, and then walk away at the end of the day, rich men. And for people like my parents, who knew nothing about investing, and who only had the modest money they earned through my mother's job as a secretary, my father's job as a bricklayer, it was a godsend. But I quickly saw that it was also a lie. I was so outraged by the passive investing model, I decided to build my own fund to beat the S&P 500. Morningstar ranked it number 1 for 3- and 5-year returns. The Wall Street Journal placed my mutual fund number 1 in the nation. I understand why more than half of Americans who invest their money today put it on a passive investing model like index funds. Except I had to recognize something was up when my system just kept beating it. And for a while, for a long time, I understood some people might still be too skittish to leave the safety of the indices and put money on an actual stock. Current market conditions have forced me to radically change my tune. As I'm going to explain to you a little later, index funds are no longer simply ineffective when it comes to growing your money. They have become downright reckless. And yet, Wall Street keeps perpetuating the myth that they're the best thing to do with your hard-earned dollars. Wall Street wants you to stay away from stocks. Now, I know we've all heard that stock picking is a risky game. I'm sure you've been told that stock picking is akin to gambling, like playing Russian roulette with your financial security. And it's certainly true that among the tens of thousands of publicly traded stocks that exist, a large majority won't go up much in a lifetime. But it's also true that if you know how to identify the right kind of stocks, and you know how and when to get in on them, it can lead to extraordinary gains. That's why, when it comes to investing in actual stocks, you don't need to gamble. You just need a system. My algorithmic model analyzes stocks based on 8 key metrics in order to highlight the best stocks on the market. And when you get in on a stock that's been highlighted by my system in time, the results often speak for themselves. As I mentioned earlier, my system has given my readers the chance to double their money on more than 675 opportunities if they held on. But it's much more than that. There's a reason they call me the earnings whisperer. My system also helped me identify over 300 stocks that went on to maximum gains over 500%, like Steve Madden, which went up more than 500% in the years following my recommendation. Now, at the time I recommended it, the company was in deep trouble. Its founder, Steve Madden, had been convicted of stock manipulation and insider trading. This was Wolf of Wall Street stuff. When the scandal broke, the company's stock plunged more than 50%. So some people might have thought me crazy for recommending a company whose founder had been literally locked away for fraud. And I would have understood their reaction, except that my stock grading system had highlighted promising fundamentals in the company's profile. And after conducting my own quantitative analysis, I had to conclude that, even if Steve himself was in hot water, his company seemed surprisingly well positioned to go up. So I told my readers to get in. And lo and behold, following my recommendation, Steve Madden's stock rose 585% in the years that followed. That's enough to turn a $5,000 stake into over $30,000 for anyone who held on. I didn't hear anybody calling it a risky pick after that performance. Or against Starbucks, which I recommended in 2010 when shares were trading for under $10 a share, split adjusted. At the time, critics could have booed me for betting on a company that was all about a high-end coffee experience. The global economy was still teetering from 2008, and people were tightening their belts. So I understand why some might have doubted the appeal of $4 cups of coffee when McDonald's and Dunkin' Donuts were selling them for half the price. But my stock rater had highlighted Starbucks as a strong rating. And my own follow-up analysis had confirmed that this was an opportunity not to pass up. So I made the recommendation, and indeed, Starbucks soared in the aftermath, gaining an astounding 987% at its highs. Any reader who had followed my advice could have seen a stake of $5,000 grow into over $54,000 if they had held on. Gains like these were always wonderful for me and my readers. My track record is full of examples of stocks that went on to soar over the years. After all, I recommended Ball Corporation in 2004, which went up more than 1,100% in the years after my recommendation. That could have turned a $5,000 stake into over $60,000. I told readers to get in on Costco, after which the stock rose 12,346%, enough to transform every $5,000 invested into more than $622,000 for anyone who held on over the years. And I recommended Franklin Electric when shares were going for only 67 cents per share in 1988. That stock went up to more than $108 at its peak for a gain of more than 16,000%. That would have turned $5,000 into over $800,000. More than 170 of my picks have gone on to deliver 1,000+% gains. Of course, these are extraordinary examples, and past performance is no guarantee for future results. But I'm still not done, because my proprietary system even allowed me to recommend opportunities that went up as high as 10,000%. That's a 100-fold return on your money. We did it with Adobe, which went up 37,722% after my recommendation. Again, this wasn't a success story most would have anticipated. In fact, early in the year when I recommended it, Adobe was all but done for. Apple, one of its main clients, had announced it was moving away from its partnership with the company and teaming up with their rival Microsoft to produce their own product. The news came as a shock, and Adobe's market aspirations were obliterated overnight. It was a near-fatal blow to the company, which saw its stock drop 30% in one day of trading. As he was tearing up, Adobe's CEO accused Apple and Microsoft of selling snake oil. And the New York Times printed an article warning that Adobe's future was grim. So then why did I recommend it to readers just a few months later? Simply enough, my stock rater had identified factors that led me to conclude that the company, despite all the drama of recent months, was actually in a good position to go up. And go up it did. In fact, in the years following my recommendation, Adobe stock positively soared, rising 37,722% at its peak. And anyone who listened to me and got in on Adobe when I recommended it would have had the opportunity to transform a $5,000 stake into over $1.1 million. And again, I didn't just do this once, nor even a handful of times. In all, over the course of my career, I've identified 22 10,000% gains. It happened after I recommended Nike in the late 1980s. Even though the shoe company had suffered horrible losses in recent years, fashionable shoes were in and sneakers were out. In only 2 years, Nike had seen their valuation plunge 73%. Under those circumstances, who in their right mind would bet on the company to go up? Well, my trusty stock grader system graded Nike a strong opportunity. And so on. After taking a look at under the company's hood myself and confirming the company's strong fundamentals, I told my readers to get in. And in the years that followed my pick, Nike took off again to the tune of a whopping 88,655%. That would have turned a $5,000 starting investment into more than 4.4 million at its peak. But my best, so far, was my recommendation on Applied Materials. At the time of my recommendation, back in 1988, the stock was selling for only 30 cents a share. In the years that followed, it consistently climbed higher. Until today, it's setting record highs, having just recently pierced $321 a share this January. Anyone who bought Applied Materials when I first recommended it and who held on all these years would have seen an incredible gain of 106,900%. That's enough to turn $5,000 into an outstanding $5.3 million, all on one well-picked stock. So I'm no stranger to big gains, and I'm always on the lookout for the next one. Because again, while these gains are among the strongest in my portfolio, this isn't just luck. This is what happens when you apply a time-tested formula to a rigorous method. And while most money managers out there can't even beat the market on a given year, my track record of hundreds of doubles or more peak gains speaks for itself. So how exactly am I finding these stocks? And why aren't most money managers doing the same thing? I'll address both of these questions shortly. First, let's be clear about one thing. When it comes to stock picking, only two things really matter. The first are the fundamentals. The second, the quantitative profile. Now, if like Crystal, when I explained this system to her over that pizza dinner that night, you'd also be giving me a blank stare right now. Just hang tight. I'm going to explain what I mean in very basic terms. Fundamentals mean a company's sales growth, earnings, and so on. Basically, I'm looking under the hood to see if the company's growing, because that means it's healthy and thriving. It means it's run by smart people who know what they're doing. If a company can't make a buck, it's obviously not a company you want to invest in. Then the second thing I look at are quantitative elements. This is a bit more technical, but you can essentially think of this as following the money. I look at things like buying pressure, market sentiment, and a number of other variables in order to answer one simple question. Is money flowing into the company? I want to see if the big money, like hedge funds and institutional investors, are taking interest in the company. Because logically, the more money that goes into a company, the more momentum that the company has to grow. To be clear, my system doesn't make predictions on its own. I use the data collected by my algorithm and look at the companies that got the best grades from my system before applying my own knowledge of the markets and experience in portfolio management in order to decide if I will recommend the stock. There are 8 factors that I focus on in particular, including things like operating margin growth, earnings momentum, and return on equity. It's like an 8-point inspection plan that allows me to focus on the most important elements of a company's health in order to assess whether a company has strong fundamentals and a quantitative value. As you can imagine, finding all the accurate and most up-to-date information for the thousands of publicly traded stocks out there is incredibly complicated and time-consuming, which is where the algorithm I built back in the 1970s becomes such a game changer. Every week, it analyzes over 6,000 stocks, focusing on those 8 fundamental criteria to determine whether a company has good fundamental and quantitative elements. And once it's aggregated all those metrics, once it's analyzed things like sales, earnings growth, and analyst earnings revisions, cash flow, return on equity, and so on, the algorithm assigns 2 grades to each company, 1 fundamental grade and 1 quantitative grade. Then it blends the 2 grades together to give it a final overall score. Every time I recommend a stock to my readers, I send a detailed report in which I explain how it fared on those 8 factors and the grade I assigned to each one. Enter the ABC system. A stock that received an A grade is logically the one that has the strongest growth and business quality. In other words, it has the strongest fundamentals that make it as close to a no-brainer as you can get when it comes to investing. A company that gets a B is often still very strong and considered a bullish opportunity. Though there's usually some aspect that made it dim slightly in comparison to an A-graded company, it doesn't mean you shouldn't invest in it necessarily, but we might adapt the way in which we hold it in our model portfolio. A C company comports more risk, but can, on occasion, still be worth investing in depending on the circumstance, and so on and so forth until you get to an F, which of course are the stocks you really want to avoid. Here's a peek at what my stock grader system looks like when applied to a portfolio of stocks. So as you can see, this system really is as simple as the ABCs. It allows us to bypass all the hoopla surrounding the big names and media attention that distracts many investors, and really look under the hood to see what's going on for real. When you start using it to guide your investment decisions, I'm confident you'll see how quickly it becomes a game changer, allowing you to identify opportunities you would have never paid attention to otherwise, and avoid the companies who are poised to tumble, taking your money down with them. Those are the F-rated stocks, and while they're less fun to pay attention to, they're just as important. Knowing which stocks are dangerous investments has saved me and my readers from losing money in the past, like Enron, which my system flagged as high risk back in April of 2001. I told my readers to get out months before it crashed to zero, and we were able to avoid the losses that left so many investors devastated. In January of 2008, my system again signaled a high level of risk on the market, and I warned of a severe downturn. My system flagged 257 stocks as F ratings at the time, including Home Depot, Eli Lilly, and Sprint. In the months that followed, Home Depot tumbled 31%, Eli Lilly lost 43%, nearly half its value, and Sprint shares reached an all-time low for a staggering 82% loss. But thanks to my algorithm's 8-factor system, which had flagged these companies as F-rated, my readers had the chance to protect their money. With my system in your hands, you don't need Wall Street smarts. You just need the ABCs. Now, I could go on giving you individual examples. I've got hundreds, but I'll save us all the time and just show you this data from our back test. It's the chart my team put together to show you what happens to the stocks ranked in my system, according to grade, compared to the S&P 500. See that gray line at the bottom? That's the S&P hanging out with my DNF stocks. Now look at the Bs. That's the red line. You see that for every $1,000 the S&P 500 was returning, B-rated stocks would have brought in over $3,000. In other words, more than 3 times as much. And all the way up to the top, that blue line that's shooting to the moon, those are my A-rated stocks. As you can see, for every $1,000 brought in by the S&P 500, my A-graded stocks would have returned over $13,000, beating out the market not just by 2-to-1 margin, but by a staggering 13-to-1 margin. That is the power of my stock grader. When it sniffs out an A-graded stock, it could help you grow your money in ways you never dreamed of. Now let's look at the second chart from our backtest, which compares the S&P 500 to the stocks that received the best grade possible in my system, what I call a fundamental A grade. This means they're graded A across all categories, fundamental and quantitative, and that usually means that, according to my 8 key metrics, they're in a very strong position to rise. Check this out. My fundamental A's blow everyone, A-graded stocks included, out of the water. For every $1,000 the S&P 500 returned, my fundamental A stocks would have returned an outstanding $385,180. That's 363 times better than the S&P 500, if you can even wrap your mind around that idea. So as you can imagine, being able to identify such stocks when they're well graded and positioning ourselves at the right time is what has allowed me to have the incredible track record I have. Of course, no system is perfect. I have my share of losses as well. You should always do your due diligence before making any investments. Tens of thousands of everyday readers use my system to grow their wealth. Like Leon H., who on his very first day of following my recommendation registered gains of $4,652. Or Angela M., who used my recommendations to make over $34,000 in profit in just a couple years. Gaston K. wrote me not too long ago saying he made over $25,000 in profits off of one of my recommendations alone. Leon, Angela, and Gaston are just a small handful of the tens of thousands of investors across America who trust my insight, as well as my proprietary strategy, to take advantage of the opportunities that most investors will never see in their lifetime. And the reason for this is simple. As we've discussed earlier, passive investment models like index funds were once touted as the safest and smartest way to grow one's money. But today, the promise of old no longer applies. Today, the indices are failing investors, and Wall Street knows it well. If my parents were still alive, I'd tell them to get their money out of the indices immediately. And if you're one of the over 70 million Americans who has a 401k, a Roth IRA, a mutual fund, or any savings at all parked in one of these fail-proof and steady indices or ETFs, you're putting your money unnecessarily at risk. The reason is simple, and it lies in the way the indices are organized. Let's take the example of the most popular index, the S&P 500. If we look at the valuations of the top 10 companies in the S&P 500 today, compared to the valuations of the rest of the index, you'll notice that half of the index value is concentrated in just 20 companies. That means the top 20 companies are worth as much as the other 480 stocks combined. But not only that, many of the companies that are leading the S&P 500 are the same companies leading the other popular indices. You'll notice that the names at the top of the S&P look strikingly similar to the companies leading the NASDAQ 100. And even the Dow Jones Industrial Average, which doesn't rank their stocks by market weight the same way the S&P 500 and the NASDAQ 100 do, has familiar names in its top 20. There are 7 companies in particular that have become more powerful than all the others, and I'm sure you already know them: NVIDIA, Apple, Alphabet, Microsoft, Amazon, Meta, and Tesla, aka the Magnificent Seven. This small but very powerful concentration of stocks has reached record valuations in recent years, with 4 of the 7 surpassing $3 trillion in market capitalization. 4 years ago, there was not a single U.S. company with a market capitalization over $3 trillion. Not one. And now, Apple, Alphabet, Microsoft, and NVIDIA all reached that exclusive club. NVIDIA, the largest among them, has a market cap of $4.4 trillion, meaning it represents 8% of the entire S&P 500 all on its own. A decade ago, the Magnificent Seven accounted for 12.3% of the S&P 500. Now, NVIDIA, by itself, represents almost a tenth of the entire S&P 500 index. And the 7 as a group make up 35% of the S&P 500's value. So what does this mean for you and your money? Investing in the indices today is not just careless, it's downright reckless. Remember how common wisdom says stock picking is risky while index investing with its diversification is safe? Yeah, forget all about that, because most indices are weighted by market capitalization. What ends up happening is that when you put your money in an index like the S&P 500, you're essentially putting your money into the Magnificent Seven. For every dollar you put in the S&P 500, 35 cents of that dollar goes into the Magnificent Seven. The other 65 cents are distributed between the other 493 stocks. But when you look under the hood of the index, you'll discover many of those other 493 stocks are floundering. You might remember that on October 29, 2025, the S&P 500 closed at a record high. It broke above 6,900 for the first time in history. There were headlines about it. People rejoice. But the truth is, on that historic day, a whopping 398 stocks in the S&P 500 closed in the red. That means that roughly 80% of the companies in the S&P 500 actually lost value. Just check out this graph. It shows the market's breadth, which is basically a technical way of saying the amount the market's gone up compared to how many stocks are actually going up. That red line on top represents the S&P 500's value. And as you can see, it's climbing all right. But that blue line down below, that represents the advancers minus the decliners. And it's at minus 239. Yes, negative 239. A balanced market in which half the stocks rise and half the stocks fall would logically be zero. We're at negative 239, which means that many companies are failing compared to rising, and that the market's being pulled up by a small but very powerful number. You know how common wisdom says you should buy low and sell high? When you buy into the indices today, you're buying the Magnificent Seven at all-time highs. And those extremely high-priced Magnificent Seven are holding up the rest of the market, the majority of which is floundering in comparison. The old adage, don't put all your eggs in one basket, exists for a reason. And yet, this is exactly what most investors are doing today. This is not only a huge mistake, but possesses a terrifying risk to your hard-earned money. Famed investors and financial experts like Michael Burry, Paul Singer, and Peter Lynch have all warned recently that investing in indices is risky. But of course, most people won't really know what to do with that warning. And most money managers will never tell you to get out of the indices, even if it's in your best interests. Look, I'll be honest, I know these guys. The ones working for Vanguard, BlackRock, Fidelity, and such, I see them at my country club. I've been invited to play golf with them or take their private jets to Cabo for a weekend. And while I'm too busy working to spend much time with them, I do know, after 40 years spent in their orbit, how they operate. For example, I know that most money managers love to cite the following fact. The average investor, if left to his own devices, will return only 3% annually on the whole. It's true that independent investors historically fall well shy of the 10% return promised by the S&P 500, falling prey to the emotional tendency to sell low and buy high. Money managers use this argument to make their job appear all the more crucial. And while it certainly pains me to think of an independent investor trying his hand at the markets, only to walk away at the end of the day with little more than he started, it doesn't mean that what private money managers offer instead is necessarily better. Again, I know these guys. They give you the impression that they'll make your money grow far better than anything the indices could do. But the truth is, and what they never want to admit out loud, is the vast majority of money managers today don't even beat the market. According to the S&P Indices versus Active report card, 85% of active fund managers failed to beat the U.S. equity benchmark over the last decade. And when you look at the last 15 years, that number goes up to nearly 90%. The reason for this is as simple as it is disappointing. Do you know what most of these guys do? Once they put away their golf clubs and finish their glasses of scotch, when they finally take a seat behind their large oak desk to manage your money, most of them turn around and put it right into the indices. After all, it's easy. All they promised you as their client was to match the market. So they make you the market. And when you are the market, you logically can't beat the market. But never mind that. Money managers are happy to take the easy way out. They'll tell you to be happy when you do 10% on the year, a handsome portion of which they'll keep for themselves naturally. This isn't just lazy management, it's deliberate negligence. Not surprisingly then, that studies have found that a majority of active fund managers don't put their own money in the funds they manage. They promise you it's the best way to invest your money and charge you a hefty fee to do so. But they would never do the same with their own money. Well, I don't know about you, but I don't think it's right that tens of millions of Americans are putting their hard-earned savings into a system that's rigged to ensure mediocrity. And with more than 1 in 2 investors having their money in some form or another in an index fund, I need you to hear this, because your money deserves better. You deserve better. I wouldn't blame you if, after hearing this today, you're tempted just to pull your money from the indices and shove it all in the Magnificent Seven. After all, the indices are floundering and those seven are doing the best, right? Well, not exactly. Now, don't get me wrong. I wouldn't call you a bad investor for having those top hitters in your portfolio. In fact, I still have one of them in my model portfolio as well. But I recommended many of them when they were still being sold for chump change, like Apple, which I recommended when it was trading for just 37 cents a share split adjusted. Microsoft, which I recommended when it was just 38 cents per share split adjusted. And Nvidia, which I told my readers to buy at $4.19 split adjusted. But those gains are in the past. On top of that, many experts believe that pocket of stocks is overvalued and heading for a sharp drop soon. And I'm inclined to agree. Remember, when analyzing a stock to determine whether it's a good investment, we look for strong quantitative elements and fundamentals, including whether a company is growing. Well, that's my concern for the Magnificent Seven. There's a reason to believe these companies could see their earnings stagnate in the year to come, their growth plummet, and their profitability tank. In fact, the CEOs of these companies have even started selling their shares in massive quantities. Like Alphabet CEO Pichai Sundar, who sold nearly $10 million in stock last November, or Nadal Satya, the CEO of Microsoft, who sold over $75 million worth of stock last September. Mark Zuckerberg has been cashing in on the peak gains of Meta in recent years. And Jensen Huang, the CEO of Nvidia, just completed the sale of $1 billion worth of his shares last October. Perhaps the most telling, Jeff Bezos is on track to sell $4.75 billion worth of Amazon stock this spring. These guys are no dopes. Let's be clear about that. They're cashing in on their company's massively overpriced valuations and selling shares while they're at record highs. While you, if you put your money in an index fund recently, well, you're essentially paying those guys top dollar for their overvalued stock. And in the months to come, I think there's a real risk we'll see the Magnificent Seven slow down, dragging the indices down with them, which doesn't mean that I'm bearish on the year to come. In fact, I'm more optimistic than I've been in a long while. When the Fed cuts interest rates this year, and I do believe it's a question of when and not if, it's going to turbocharge the markets. I said this as early as mid-December of last year when I went live on Fox Business and declared to Maria Bartiromo that we'll see 5% GDP growth in 2026. At the time, she did a double take. She couldn't believe it. As Maria herself said, that's a big deal. It was an incredibly bullish call compared to what most analysts were saying. And yet, 1 month later, Treasury Secretary Scott Bessent took the stand at Davos in the annual World Economic Forum and confirmed exactly what I said. So please, this isn't just blind optimism. This is really happening, and it's happening now. And if you want to take advantage of the uniquely bullish conditions we're seeing for 2026, it's imperative that you get your money out of the indices now, because the best wins won't be made by treading water. As I've shown you today, my system would have consistently beat the indices in the decades since I first started using it, with an average performance that doubles that of the S&P 500. Today, I'd like to give you the opportunity to join me and start using the system for yourself. I won't recommend you just go buy the Magnificent Seven and call it a day, or that you shove money into another passive index and pretend to be happy when we come close to matching the market. But I'll actively be recommending the strongest stocks in the market today according to my proprietary algorithm and its 8-point grading system. Now, that being said, I still think some of the Magnificent Seven are worth investing in. And when you unlock access to my stock grader, you'll see how it currently grades each one. But there's another company, one that stands alongside the Magnificent Seven and is essentially knocking at the door of that exclusive club, which represents a far more interesting investment opportunity today. As of right now, my stock grader system ranks this company as a rare fundamental A, meaning the time to get in on it is now. I'm going to tell you which stock that is entirely for free in just a moment. But first, I need to tell you that my stock grader system has led me to 7 other companies that I believe are incredibly strong with huge potential upside in 2026. And they're all concentrated in a particular sector, one that analysts are calling more critical than ever before. The report's showing it's set to gain huge steam in the months to come. I want to give you the names of my top 7 must-have stocks to put in your portfolio today. These stocks are currently all rated A's or B's in my system, meaning they're fundamentally strong. But that could change in the coming weeks as my stock grader rates companies on a variety of different factors that are sensitive to market changes. So don't leave just yet. Keep in mind that my stock grader system gave an A grade rating to the top S&P 500 leader every year since 2012. And the backtests show that grade A stocks in my system have historically led to these companies outpacing the market by 13-1. And I want you to get in on my top 7 before they take off. All 7 of the stocks that my stock grader system highlighted for this year are in one domain in particular. You've surely heard about it on the news. And while I bet 9 out of 10 investors can guess what domain I'm talking about, I'm just as certain most people will have never heard of the particular companies I believe are set to benefit from this sector soaring in 2026. You see, the specific domain where the top companies in my stock grader system keep being selected right now is infrastructure. More specifically, data center infrastructure. What many consider to be the key component in the race to the top of the tech and AI boom. We've all heard about the various advances of recent years. Artificial intelligence, self-driving cars, medical breakthroughs, and more. They represent huge frontiers with enormous potential. But they all have one important limitation. They need power to run, and not just a lot of it, more than we currently have. Today's power grids are woefully insufficient, and any country that wants to be at the forefront of AI and the tech revolution will need to find answers in the form of data centers. Without them, there's no great technological or AI advances to speak of. So while everybody's laser focused on the companies leading the pack of the AI race, many of which make up the Magnificent Seven today, companies like Nvidia, Apple, Microsoft, there's a small collection of lesser-known companies that are quietly positioning themselves as the critical infrastructure builders of this new frontier. In fact, I have identified 7 companies that are poised to take the lead on conquering this new frontier. It's all starting to develop, with U.S. data center construction plans that went through the roof in 2025. Last year, the amount of data center capacity that was either built, planned to be built, or in the process of being built hit a record 80 gigawatts last year. Now, I know that number might feel abstract, but that's positively huge. To give you an idea, that's enough energy to keep the lights on in half of America. And as you can see in this graph, it's more than twice the amount the year before, and 8 times higher than in 2022. And yet, of those 80 gigawatts of data center capacity in development, 65 are still in the early planning stages, which means there's still lots of room for growth. And more importantly, a window of opportunity for you to get in now before it takes off. It's not surprising, perhaps, that my stock rating systems gave strong ratings to companies that play a role in the race for data center infrastructure. Because while heads are turned looking at the big names, we know the big wins can be made by the companies who haven't already hit their peak. Companies with strong fundamentals and even more compelling future upside potential. Experts agree that when it comes to data center infrastructure, the growth spurt is going vertical. I hope you understand. When it comes to taking advantage of this new frontier, there's no time to waste. I want you in on these 7 companies now before the others catch on and it's too late to make the biggest gains. 7 companies to replace the Magnificent Seven and put you in position to see unprecedented growth in the months and years to come. But you need to get in fast. Right now, my stock rating system has all 7 of these companies rated as strong buys. But that could change quickly with earnings season upon us. And I want to make sure you have the chance to get positioned before the rest of the market catches on. That's why I've assembled everything you need to know, the names and tickers of these companies, as well as the logic behind their strong ratings and how to act in a special report I've titled The New 7 Stocks Set to Dominate 2026. I want to send it to you today. All you have to do to get your hands on it is try my investment letter, Growth Investor, risk-free. You've seen how straightforward this strategy is. My own daughter is able to use it on her own portfolio. And you've seen how consistently it's allowed me to outperform the market for over decades, to the tune of 2-to-1 for the last 30 years. Today, I'm giving you the chance to start benefiting from StockGrader's powerful system as well. When you join Growth Investor, you will unlock access to the same system I used to uncover Apple at 37 cents a share, Applied Materials at 30 cents a share, and Microsoft at 38 cents a share. You'll have my proprietary stock grader at your fingertips, meaning you can use it to see what it grades any of more than 6,000 companies on the market today. But of course, you won't be alone faced with this powerful tool. To make your experience as easy as possible, when you sign up for a 90-day trial of Growth Investor today, I'll immediately send you the Stock Picking ABCs, Growth Investor's Owner Manual. This is the plain English guide to my system, how it works, how to use it on your own money, and how to avoid the costly mistakes most investors make when they rely on index investing. This report will also show you how to move away from low return, high concentrated index exposure without complexity, without expensive advisors, and without guesswork. And once you're set up and ready to roll, I'll send you a new issue of my flagship advisory every month, in which I break down what's happening in the markets, as well as any new developments my stock grader may have highlighted, and how we might take advantage of these opportunities before they go mainstream. I'll usually include one new investment recommendation each month, highlighted by my proprietary stock grader system. Again, this is the same stock grading system that helped me make my first million by my early 30s. The system that allowed me to provide for my wife and 3 children for more than 4 decades. And the one still protecting my daughter, Crystal's financial future as she pursues her life in New York City. Today, you have the opportunity to put that system to work for you. When you join today, you'll have 3 full months to review my research, use StockGrader, and read every report completely risk-free. If at any point you decide Growth Investor isn't for you, just let us know within 90 days and you'll receive a full refund. No questions asked. No complicated red tape to work around. You'll even be able to keep the bonus reports. But I don't think that'll be necessary, because there's no reason to keep settling for whatever the indices happen to deliver. No reason to be satisfied when a money manager pockets a handsome sum just to offer you mediocre returns at best. You and your money deserve better. Again, backtests show my system would have outdone the indices tenfold overall since I first started sharing my stock grader strategy. And the very best of them, the ones I call fundamental A's, would have delivered cumulative gains of over 385,000% in the year since I began recommending them, which far outshines the S&P's 1,059% return. I hope I've made it clear to you today. The right stocks, when well picked and bought at the right time, can vastly outdo the overall market. So act now, because the 7 stocks I want to send you today all have the quantitative and fundamental qualities to be the next market leaders. And I don't want you to waste another moment. Which reminds me, I promised to tell you which company adjacent to the Magnificent 7 I consider a prime investment for the year to come. I'm predicting a big flip in 2026 away from overvalued stocks that have been leading the market despite lagging fundamentals, back to companies with strong fundamentals and outstanding earnings. As of right now, the stock I'm about to share with you is earning a quantitative grade of A in my stock grading system. And given how I see the markets panning out in 2026, I believe it's a must-have stock for our portfolio. So which company is it? It's Palantir Technologies, the company known for its software development and data analytics, a leader in the AI race, an undeniable front-runner in my stock grader system. Currently, the company scores an A across the board for sales growth, operating margin growth, earnings momentum, earnings growth, and more. And with AI and data center stocks on the rise, all signs point towards institutional buying pressure that will drive Palantir Technologies to new heights. Currently, Palantir Technologies shares remain below my target range, and I believe it deserves a serious place in your portfolio heading into 2026. That's why I recommend buying shares of Palantir Technologies, ticker symbol PLTR, today. My stock grader system leaves me confident that we'll see its value continue to rise in 2026. Although the truth is that's far from the only stock I think we'll see take off in 2026. As I said earlier, I'm extremely bullish about market conditions in 2026. And there's one more company I want to tell you about before we finish. A company that deserves your immediate attention. An A-grade stock my system flagged early with the kind of upside most investors only hear about after it's too late. Much like Nvidia back when I first recommended it, I believe this company could be the next big win opportunity. Like Nvidia, it's another strategic player in the digital infrastructure boom and firmly at the heart of the global connectivity revolution. But unlike Nvidia, which has shot up more than 4,000% in the years since I recommended it to my readers, this company is not a household name. Or not yet, in any case. You've probably never heard of this company before, even though this company was featured positively in Barron's and Zacks recently. But with revenue surging over 20% and earnings jumping nearly 47% last quarter, the fundamental and quantitative elements of this company are off the charts, and analysts are scrambling to raise their earnings forecasts, which means again that the time to act is now before this company takes off. I've laid out everything you need to know in a confidential report titled The Next Nvidia, My Favorite Stock Pick, Set to Go Sky High in 2026. Inside, you'll find the name and ticker symbol of this stock, as well as how best to invest in it. You'll immediately receive this report when you start your growth investor trial today. When you join our community, you'll join tens of thousands of readers across America who understand the power of owning the right stocks, instead of staying bogged down in bloated indices. Like Rodney, who wrote in to say, I'm already up 375% so far. Or Juanita, who turned $12,000 invested in Nvidia into nearly $700,000. Or Betty, who followed my Apple recommendation years ago and saw it grow into more than $400,000. Or again, Ken G, who says, I always wonder where investing newsletters get their testimonials and whether they are real. But with Navellier, they must be, because I have made well over $100,000 in the last year on just 2 of Louis' recommendations. Thank you for helping independent investors like me navigate the markets. So join me today for a risk-free 90-day trial of Growth Investor and discover the power of my ABC stock picking strategy yourself. Here's everything you'll get when you join Growth Investor today. When you join Growth Investor, you'll receive 12 monthly issues of my flagship advisory, 1 new investment idea on average each month, plus full market analysis, immediate access to my proprietary stock grader, which rates around 6,000 stocks, and weekly updates and buy-sell alerts. Plus these 3 special reports free. The new 7 stocks set to dominate 2026. The Stock Picking ABCs, Growth Investors Owner Manual, and the next Nvidia, my favorite stock pick set to go sky high in 2026. Normally, Growth Investor costs $499 per year, but today you can take advantage of a huge discount off the normal price. Just click the Get Started button below to see all the details around today's special offer. And remember, you're protected by a full 90-day money-back guarantee. Look, you can remain where you are and sit on your S&P 500 index investment like a hen waiting for an empty egg to hatch. You can choose to stick around to see if the Magnificent Seven will continue to have their day in the sun, despite all the warnings to the contrary. Or you can follow my straightforward and successful strategy, the very same my darling daughter's portfolio is invested in. And finally, put yourself in position not to just beat the markets, but run circles around it. For nearly 30 years, I've been using my stock grader system to beat the markets 2-1. It's helped tens of thousands of readers across America make gains they would have never thought possible otherwise. Like James P., who wrote to say, your insights and recommendations based on all those years of experience have been invaluable to me as an investor. Thank you once again for your exceptional service. Or Zoltan, a scientist from Hungary, who said he never invested in stocks until he joined my service. Or again, Jennifer E., from whom my newsletter is her Bible on the stock market. I'm so grateful to be trusted by my community, and it matters to me that I make sure I'm always keeping my readers abreast of the latest market trends and news, which is why after a few years ago, I also started a podcast for my community. I call them my Special Market Podcast. As soon as you confirm your trial of Growth Investor, I'd like to add your name to my share list. Now, don't worry, I'm not going to make you sit through hours of me pontificating and shouting the breeze with whichever friend I decide to invite as a guest this week. My Special Market Podcasts are updates I've designed to be useful and concrete. I send 2 to 3 podcasts a week to keep you apprised of the latest market developments and discuss what's happening in the markets and my analysis of what this means for us and our portfolio. In recent episodes, I've discussed things such as the impact of the upcoming inflation reports on the markets and how political pressure is weighing on financial stocks. The idea is that you can simply listen to this with your first cup of coffee every morning or with a glass of wine at the end of the day and remain leagues ahead of the other 99.9% of investors out there. So accept my trial offer of Growth Investor, and I could be chatting with you as early as tomorrow morning. I hope you can sense how excited I am for the year to come. With the stock grader system signaling strong buys on these 7 companies and a handful of other stocks presenting strong grade A potential for months to come, I have good reason to expect a strong year to come. We may even beat 2025, which was one of our best years yet. By the close of last year, the open recommendations in my Growth Investor portfolio were up 28%. With the S&P delivering 17% returns. That means our open portfolio at Growth Investor did 1.5 times better than the S&P 500. I wonder how many money managers can say the same. And I believe the gains will keep flowing in 2026. With robust GDP growth, strong consumer spending, and steady inflows from global investors, we remain in one of the best earnings environments in years. Of course, nothing's guaranteed, and it wouldn't be honest of me to pretend that I could make any absolute promises. All investing carries risk, naturally, and past performance is no guarantee for future results. So please, never invest more than you would be comfortable losing. But I want you to know that when you join Growth Investor, a promise I can make is that I'll be there with you to guide you through thick and thin. My service has been at work for close to 4 decades through many periods of boom and bust, so I know a thing about navigating market shifts and changes. Through it all, I've kept my readers afloat. Since I began my first newsletter, my recommendations have allowed my readers to outperform the markets 2-1, which means that even when the economy's not doing great, my readers still feel protected. Like Jerry M., who wrote, "I'm retired now, and thanks to you, I have money that makes my retirement more enjoyable and comfortable. Now I have money that I could never dream about, all thanks to you, Louis." Like Robert K., who wrote to say, "I wish I'd found your service earlier." Or David R., who wrote, "I generally do not like to tell other people how to invest, but your investment letter will allow you to gain wealth, and I think everyone wants to live with no financial worries during retirement. I'm honored that my readers trust me when it comes to finding the best investment opportunities. It's a responsibility I take very seriously, which is why, to that end, I'd also like to send you an exclusive white paper titled 99 D and F rated stocks to sell now. My goal when it comes to the growth investor community is to help you identify the best opportunities in the market thanks to my proprietary stock grader. It's just as important that I help you stay away from the most dangerous stocks out there, because your money won't grow if it's getting lost in stocks you should have avoided altogether in the first place. But again, without a reliable tool at your disposal, it's nearly impossible to know which stocks constitute a threat to your portfolio. Luckily, my system is designed to highlight not only the cream of the crop, but the bad weeds to get away from ASAP. I've compiled a comprehensive list of the 99 stocks currently graded Ds and Fs in my stock grader and want to get this report in your hands immediately. As soon as you get it, I want to make sure your money isn't invested in any of the stocks listed. And if so, I want you to sell immediately. Of course, you'll be able to pivot and save money from unnecessary risks thanks to my comprehensive user's manual. I'll send you this list as soon as you accept your risk-free trial. And I hope it'll help guide you in your own portfolio management, whether or not you choose to stay with us. So please, don't lose any more time letting your money flounder in stock market indices, especially when we have 7 amazing stocks to get you in on before today's end, and 99 stocks to avoid if you want to keep your money safe from harm. As soon as you confirm your risk-free trial of Growth Investor, I'll send you all the information you need immediately. As a reminder, here's everything you get once you take this risk-free trial to my letter, Growth Investor. You'll receive 12 monthly issues of my flagship publication, Growth Investor. Each month, I will email you a new edition of my Growth Investor advisory letter with one new investment opportunity on average and my full analysis of the market. On top of that, my team and I will send out weekly updates and buy and sell alerts. You'll also receive the featured report, the new 7 stocks set to dominate 2026. The bonus report, the stock picking ABCs, Growth Investors Owner's Manual. The second bonus report, the next Navellier, my favorite stock bet set to go sky high in 2026. And the third bonus report, 99 D and F rated stocks to sell now. You will also have access to my stock grader, so you can check out the grade of about 6,000 stocks anytime you want, as well as my regular special market podcasts. So come join us at Growth Investor. And once you join my letter, you'll never have to go at it alone again. Instead, you'll have the research you need to be putting yourself in position to take advantage of the best opportunities in the market today, starting by getting your money out of stock market indices and into the 7 stocks poised to lead the race for data centers, including an 8th that I think could be the next Navellier in 2026. You'll be able to start fresh by following a disciplined, time-tested system, the same one my family relies on, and my 25-year-old daughter used to beat the markets 2-1. If she can do it, there's no reason you can't. I've got all the information you need today to get started, and I'm ready to send it to you as soon as you accept my invitation to try Growth Investor risk-free. I look forward to having you among us.